Hey everyone, today I'm going to cover how to depreciate an asset by 3 different methods. So I'm going to depreciate this particular asset using the straight line method, the units of production method, and the double declining balance method. These are the typical problems you will see in an introductory financial accounting course and even later on. So it does get a little more complex as you get into like an intermediate accounting course. But this is the type of problems that you're typically going to see. So like I said, we're going to depreciate the same exact asset using the 3 different methods. So the reason why we have the 3 different methods to learn is because each business can choose what type of method they want to depreciate their assets. And it doesn't have to be the same. So say you have a piece of machinery, but you also have a vehicle. You may want to depreciate that machinery based on the straight line method, but then the vehicle based on the units of production method, because vehicles will typically be depreciated by the miles that were driven. So you're going to want to do that based on usage versus just a singular method. So you have the same depreciation every year like you would with straight line. So each individual business can choose what method they want to use. I also want you to keep in mind that this is not a literal depreciation. So just because we've depreciated an asset fully, say after 5 years, doesn't mean it doesn't have any value. So it's just a way for accountants to recoup that initial cost, because if you remember correctly, any assets you buy have to go on the balance sheet at cost. So it's just a way to recoup that cost in the form of an expense. So we're taking an asset and moving it into that expense category as that asset gets used up over time. So let's go ahead and get through this problem. So under the required section, it says determine the depreciation for the equipment listed above for the current fiscal year and the following fiscal year by the straight line, units of production, and double declining balance method. So I've got a year 1 and 2 for each of the different methods going on here. So let's look at the problem. It says the cost of the asset was $60,000. The residual value is $4,000. So residual value is the value of any asset at the end of its useful life. So what you're expecting it to be worth. Again, it's an estimate. So this can change over the course of the asset, and then you would want to do a change to the depreciation at that stage. So residual value can also be called salvage value. So depending on what type of textbook you're using, they can call it 2 different things, but essentially it means the same thing. It's whatever is the value of that asset at the end of its useful life. The useful life for this particular piece of equipment is 8 years. The useful life in hours, which we're going to need for the units of production method, is 50,000. Hours used for year 1 and year 2 are as follows. So they use it for 6,000 hours in year 1 and 6,200 in year 2. So we're going to need that again for the units of production method. So let's go ahead and finish this problem here. So I'm going to put my answers over here, but I'll put the formulas I'm using to the side so that you guys can follow along. So for the straight line method, so what you always want to do is take your cost. So let's go ahead and put this in parentheses. Take your cost, subtract out any residual or salvage value, and then divide that by the useful life. So in this case, our cost was 60,000, residual value is 4, useful life is 8. So cost minus residual value divided by the useful life gives us $7,000. And because it's the straight line method, it's going to be the exact same for every single year. So at the end of the asset's useful life, at the end of 8 years, it's going to be worth the residual value, essentially $4,000, because 7 times 8 is 56. 60,000 minus 56 is that 4,000. So we're going to do 7,000 every single year. Oops. For 4 years, or 8 years, not 4 years. All right. So straight line method, every single, the same amount every single year for the asset's useful life. Okay, so that one's pretty easy. So we have a 7,000 for that. Our units of production method, our formula for the units of production method is the cost again of 60,000 minus our residual value of 4,000. And you're going to divide that amount. So there's 2 steps for the units of production method, 1 step for the straight line method, and 3 steps for the double declining balance method. So it gets progressively more complicated as it goes along, but essentially it's still the same. So take this and divide it by the total hours that you expect to get out of this piece of equipment for the entire useful life. So in this case, it's going to be the 60,000 minus 4,000, the residual value, divided by the 50,000 hours. And that will give us the amount we're going to depreciate the asset per hour. So essentially, for every hour that we use this piece of equipment, we're going to depreciate it $1.12. So that's step one. Step two is to take your depreciation per hour and multiply it by the number of hours used for any particular year that you're looking to get your depreciation for. So in year one, we used it for 6,000 hours. So you're going to take the amount you use per year, which is 6,000, multiplying it by our depreciation per hour, and that's going to give you the 6720. So that is the amount you're going to depreciate the asset according to the units of production method for year one. In year two, we're going to still use the same $1.12. We're going to use that throughout the life of the asset unless, like I said, the residual value changes. Then you'll need to update it. But at this stage, we haven't changed our residual value in year two. So take your depreciation per hour and multiply it. So the $1.12, multiply it by the number of hours used in year two, which in this case was 6,200. So we're going to depreciate at $69.44 in year two. Just go ahead and equal this. Oops. All right, so $69.44 is our depreciation for year two. Double declining balance, again, has 3 steps. So we have 1 step for straight line, 2 steps for units of production, 3 for double declining balance. So I set up a little chart down here. So to get our double declining balance, we're going to take our cost. So always start with the cost. Do not take out salvage value in double declining balance method because you're going to end up with a salvage value of 4,000 and adjust at the very end. So in the 8th year, you'll need to adjust for that residual value. So go ahead and take a look at your textbook. I'm not going to go all the way through the 8th year, but take a look at your particular textbook and they will have a problem that does end up at the end of 4,000. So you need to adjust for that at the end. So just keep that in mind. So I'm just going to do the 2 years here. So start with the cost. Again, do not take out salvage value. Let me just go ahead and equal so you can see where I'm pulling the cost. So start with your 60,000. The next step is to get your double declining balance rate. So your double declining balance rate is always 1 divided by the useful life. So useful life in this case is 8 years. All right, so you got your 1 divided by the useful life of 8 years and then multiply that times 2. Essentially, it's twice the straight line rate, which is why they call it double declining balance. So twice the straight line rate, just not adjusting for the residual value. All right, so 1 divided by 8, multiply that times 2. Our double declining balance rate is 25%. So I already had it set up to get the depreciation, but how you do that is take your depreciable cost, which is always start with the straight cost, don't subtract out salvage value. So our $60,000 cost, multiply that times the double declining balance rate of 25%, and that gives you $15,000 depreciation for year one. So I'm going to go ahead and just equal that so I have that up here. All right, for year two, our depreciable cost is not $60,000 in year two because we've already depreciated it some. So you're going to have to take your original cost, subtract out any depreciation you took in year one, and our new depreciable cost is $45,000. Our double declining balance rate is still 25%. Again, that does not change. So we're going to take our depreciable cost in year two of $45,000, multiply it by 25% to give us our depreciation in year two of $11,250. And you'll continue to do that. So in year three, you would take your $45,000, subtract out the depreciation in year two, and that would give you your depreciable cost for year three, and then multiply that times 25%, and it will continue to go down every year until it will flip-flop. So if you compare the 3 methods here, so straight line is the same thing every year. Units of production will depend on how much you're using the asset in any particular year. You can see it's a little less than the straight line rate, so maybe they're using it a little less, but they're going to continue to use it more as the asset goes along. Until it's depreciated all the way down, you never want to go past this residual value. All right, double declining balance will be more in the first years and less in the following years. So there will be a time where it will be less than the 7,000 straight line because you depreciate the asset all the way down to it gets to 4,000. So the reason why a company would choose to use a particular method over another, if it's like just a normal piece of equipment that you don't want to keep track of the hours and you just want to do it, straight over the useful life, just use the straight line method. If they want more depreciation up front, because if they have more depreciation, it's more expense they're showing on the income statement, less of a net income, which they're going to pay less taxes. So that's why they might choose to do double declining balance, but it will even out. You will have the same depreciation over the life of the asset. So for this particular asset, it doesn't matter which method we use over the useful life. Essentially, after 8 years, it will all be depreciated by 56,000. So that's the original cost minus the salvage value. You can only depreciate it up to that 4,000 residual value because it has to have that value at the end of its useful life. It's just the amount per year will vary depending on which method you are using. So again, it's the same over the useful life, but it varies per year depending on the method. So it evens out in the long run. Essentially, it's just what the particular company chooses to do. Do I want more depreciation up front? Do I want to depreciate it based off of what the asset is using, like miles driven or hours used? Or do I just want a simple method so I don't have to worry about it and just depreciate it over the same amount every single year? So again, it's up to each individual business, but I hope this gives you an idea of how to complete your depreciation problems in your financial accounting course. And if you'd like to see any additional videos, make sure to comment below and like our page and subscribe so that you can keep up to date. So as you're going throughout your accounting career, I will be continuing to add videos for tax, cost accounting, hopefully maybe some intermediate accounting in there. So if you're continuing on with accounting, it'd be a good channel to subscribe to so that you know how to do any particular problem. Again, if you would like to see a particular video on a certain topic, just comment below and I'll try to make a video regarding that. So that is it for our depreciation problem. So happy studying.